5 seconds to the open.
Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to you all around the world. Welcome to the Follow the Money podcast. Today's episode number 481. We're entitling Tariffs, Trade Wars, and Opportunities, Investing in the Eye of the Storm. You know, we really want to talk about how to navigate the uncertainty and profit from some of the market shifts that we've been seeing. And that's really the purpose of this broadcast, is to help you become a better investor, better trader. And really much of that has to do with your psychology, how you actually handle a changing environment. And we do have a lot of uncertainty right now. The market doesn't like uncertainty. But what I want to do is I want to break apart some of the things that have been happening this week. This has been a big week in terms of the new tariffs that have been put in place by the Trump administration and a lot of the things that have been going on around it. As I mentioned, we're living through one of the most volatile and unpredictable economic, periods that I can remember. If you're an investor, a trader out there, someone who manages money, you already know that market turbulence is really kind of the new normal. And here's the thing, volatility is where the opportunities are. Many times we run and, get scared when we see the volatility in the market, but that's actually the place where we can find great opportunity. And the investors who can really separate the noise from the signal are the ones who come out ahead. Now, as I've said many times, in times of uncertainty, the best investors don't panic, they adapt, right? They strategize, they seize opportunity. And today we're going to dive deep into the latest tariff war developments. We're going to talk about how they're shaping the markets. We're going to talk a little bit about inflation and Fed policy and investment opportunities in the months ahead. We see the macro environment is shifting rapidly. We see tariffs, we see the global economic realignments, maybe even some big changes in the global supply chains, which could really disrupt the overall market. Many investors make the mistake of reacting emotionally to headlines instead of identifying long-term trends. But as I state, volatility creates that opportunity. And right now we're looking at a landscape full of discounted assets. We're seeing emerging trends develop, and there's some overlooked investments. So in this new podcast episode, I want to cover what the new tariffs mean for key industries. And I also want to talk about how the Federal Reserve is likely to respond and why that matters. We'll also talk about why we expect the U.S. dollar to continue to weaken this year and how to position for that. We're going to talk a little bit about Bitcoin and crypto. We have a big meeting coming up this week on Friday where President Trump and the administration is expected to unveil the strategic crypto reserve. So we'll get more details on that, supposedly. And we'll talk about how to capitalize on some of these market overreactions we've been seeing in 2025 and beyond to help you build wealth. So with all that said, let's jump right in. Well, if you haven't heard, the U.S. has officially imposed 25% tariffs on imports from Mexico and Canada, with an additional 10% tariff on Chinese goods on top of the previous duties that they had already placed on China. And the response, you could probably imagine, right? The response from Canada, from Mexico, from China, we're getting retaliatory tariffs. So this is what we call a trade war. That means higher costs for U.S. businesses. It means disrupted supply chains. It means a shock to global trade flows that investors need to be prepared for. And when we think about the sectors that are at immediate risk, we think of retail, right? So companies like Target and Best Buy have already warned that consumer prices will rise due to the tariff-driven cost increases if they are not, changed, if they're not, if Washington doesn't change its tune. Also, automobiles, we're expecting some pickup truck models could increase by $8,000 to $9,000, maybe even $10,000 because of auto parts tariffs. So too, you have agriculture, which is expected to be hit very hard. U.S. farmers are facing for higher fertilizer costs They're looking at lost export markets as China and Mexico retaliate against, Washington, and as a result, U.S. farmers. We also have the construction and real estate industry, lumber and building materials, which largely come from Canada, are expected to rise. That's going to push home prices potentially even higher. And so that's really not a good thing for the United States when you think about it. You got the auto industry in the crosshairs. You got the U.S. agriculture taking a hit. You have these higher import costs. And when you couple that with the slowing economic growth that appears to be happening right now in the United States, well, that leads to what we would call stagflation risk. So if these tariffs stay in place, and by the way, we're supposed to get some information later today. I'm recording this broadcast before an expected announcement from the Trump administration, where Trump is expected to make an announcement regarding tariffs on Mexico and Canada, not China. And the Commerce Secretary, Howard Lutnick, had indicated that there could be a change that was somewhere in the middle in terms of what Trump is going to demand from these countries. And so potentially give us some tariff relief to these companies, including automakers, which seems to be the primary thing that everybody's focusing upon. And so we will see. That could be a good development, but we'll be watching to see what happens with that. As I mentioned, I'm recording this before that statement, so we don't really know what that's going to be. But it sounds like there might be some relief for automakers. Now, obviously, this volatility that we're seeing in the markets creates opportunity. And while some sectors are at risk, there are some clear investment plays for those who think ahead. I'm looking at, for example, industrial and infrastructure stocks. If tariffs persist, companies will reshore manufacturing to the U.S., right? I think that's really the overall goal of the Trump administration. Beneficiaries there will be steel companies and machinery and automation, logistics firms. You also have some energy plays. I think, while I'm pretty bearish on oil right now, because I see the Trump administration is really trying to drive down oil prices in order to drive down the overall inflationary pressures. It's really a lot of the inflation comes from energy prices. Then I'm seeing some pretty good opportunities here in domestic natural gas and renewable companies. They could benefit as supply chains shift. And renewables have really been hit hard, over the last few years. And so there is a case where we could see some kind of a spark there. In terms of markets outside of China, some of the emerging markets like Vietnam and India, these could gain U.S. investment as alternatives to China. And, one way to do that is to focus on ETFs that track those economies. We do that. We actually have our ETF leaderboard here for our members, followthemoney.com/ETF-leaders. And our members can go there and look at all the different ETFs. We track about 150 different markets, and you can see what's working, what's not, what's trending, what's not. So there's ways to trade those markets with ETFs. So too, one of my favorite places to focus on is tech and automation. Companies will invest in AI, robotics, and automation to reduce reliance on foreign labor. So I think you're going to continue to see those areas benefit. Now, as I mentioned, there are some signs that Trump may water down some of the tariffs, particularly on the automobiles and energy imports. And if those tariffs are softened, then companies that have seen major sell-offs, like automakers and retailers, could rebound pretty quickly, could get a V-shaped recovery in some of those markets. This could also ease some inflationary fears, making the Fed more comfortable with rate cuts later this year, which we think is definitely going to happen. I've been saying since the beginning of the year, we expect at least 3 Fed rate cuts in 2025, but that could even rise even further. We think there's a case to be made that you could see 4 or 5 rate cuts this year. Of course, if those tariffs are watered down, that's going to help the markets because, again, the markets hate uncertainty. That's the main thing they don't like. When they don't know what's going to happen, that's when the markets get really zany. So a tariff rollback of any kind could really trigger a relief rally in key sectors. So if a compromise is announced later today or sometime this week, then I would expect stocks in retail, auto, and supply chain dependent industries to bounce pretty good. That's at least my expectation. That could present some really great short-term trade setups for those who are watching the markets pretty closely. Now, let me talk about, I want to talk more about the outlook in the market here in a few, but let's talk about the Fed for a minute, because the Fed, many people have been wondering, is the Fed going to cut any more rates? They had that rate cutting campaign that they began last year, but then it came to a halt. And many investors are watching the Fed for clues about rate cuts this year. Now, where I stand, as I stated, I expect a minimum, at least 3 Fed rate cuts in 2025. We have inflation that, barring any kind of really aggressive tariffs that get out of control, again, I think we're going to see a compromise here. Therefore, inflation is likely to continue trending lower, especially thanks to falling energy prices. If you haven't been looking at oil prices lately, you might be surprised. They have really been plummeting, and that is a key input into the CPI, into the consumer price index. And so if energy prices fall, particularly oil, then you're really going to get some relief in terms of inflationary pressures. And that will help offset any potential rise in inflation from these tariffs. In fact, these tariffs really aren't expected to generate too much in the way of inflation. They will, but the estimates I've seen are fairly muted. So again, the offset from falling energy prices and other items as well. We've seen a lot of falling prices in food supplies here in the United States, as far as the actual wheat and corn and soybeans. They've been falling in price. And so you have that. And then I also expect the U.S. dollar, which, by the way, crossed below its 200-day moving average today, as I record this morning. For the first time, it's actually touched that line for the first time since last September, October. Or maybe it was October, November. Yeah, I think it was October, November. But the point is that that's a pretty big deal. And now you have the dollar at a 4-month low, and that has huge implications for global markets, right? So a weaker dollar benefits multinational stocks and companies with international revenue exposure. It also benefits precious metals like gold and silver, which we're seeing strengthen today. I saw silver's back above $33. Gold's just within a hair's breadth of a brand new all-time high. It could also help Bitcoin and digital assets, which I want to talk about a little later in today's broadcast. And they could become an even stronger hedge against currency devaluation in that case. Now, I want to talk about more of these assets here in a few minutes, but let me just talk about the stock market outlook here, where the best opportunities lie. I know the headlines make it sound like the market's falling apart, but when you actually zoom out, you see that we're in one of the better environments for long-term investors. The key is knowing where to look. Now, I have a long-term time horizon on my long-term investment portfolio, so I'm not really too worried about what's going to happen next week or even next year when it comes to my stock portfolio and even my crypto portfolio, because I have long-term holdings. Now, if I'm trading, well, yeah, I absolutely am concerned about what's happening right this second or next week. But if I am investing, why do I care what's happening this week or next month or even next year if I have a 10 or 20-year time horizon, right? In fact, any weakness is actually just good for the long-term investor. And it's difficult to think that way. We tend to often gravitate towards the fear with the volatility, and it can even cause people with a long-term outlook to sell into weakness, which really, I don't think is a good idea for the most part, but to each his own. Now, I do remain bullish on high-quality stocks and ETFs over the long term, right, with a long-term view. So I'm coming at this from a long-term investor perspective for this broadcast. In my opinion, the AI revolution is not slowing down just because of the latest trade wars or tariffs or whatever, even slowing economic growth, right? None of that is going to deter the AI revolution. Companies are in the artificial intelligence space, semiconductors and automation. I continue to think these are very important companies to be looking at for long-term investors. So too, the Dividend Aristocrat list, which we put out each month for our members. We like dividend-paying stocks. We think they're set to outperform because investors are typically rotate into stable yield alternatives as rates fall. And we are seeing rates weaken here in 2025. That bodes well, for those high-quality dividend-paying companies, especially those who grow their dividends. Let me stress that. Just because a company has a dividend doesn't really mean much. It's good. It's better than not having a dividend, but it's the companies that grow the dividends over time, especially annually, that really tend to outpace the rest of the market. So we like dividend-paying stocks that increase their dividend on an annual basis. And if those are in the S&P 500, we call them S&P dividend aristocrats. We also think that emerging markets are also going to benefit from a weakening dollar. I'm watching certain international ETFs as a potential play on that. I'm going to be talking about that to our members on some upcoming broadcasts that we do for members only. But some of the sectors we think that could benefit here, certainly tech, AI, cloud computing, semiconductors. We remain bullish on these longer term and in 2025. Healthcare and biotech. We think there's a lot of long-term growth here, a lot of undervalued names, and healthcare has really not participated too well in even the bull rally that we've had as of late. So healthcare, we think there's some interesting opportunities there. And then, of course, industrial companies, which really did well underneath Trump's first term, and we think will continue to do well in his second term as companies, really benefit from the reshoring and the infrastructure spending that we expect to see underneath this administration. So I've got a lot more to say. I want to talk about crypto and the upcoming White House summit. I want to talk about oil and energy a bit more, and gold and bonds, and maybe even some more strategies for traders and investors. And then we'll wrap things up with kind of the big picture. But let's take a quick break. We'll come right back with more of our discussion on the current trade war and the opportunities that are right here in front of us. Hold tight. Hey there, traders. Jerry Robinson here. Before we jump into our market update, let me take a quick moment to introduce you to our brand new video course, Swing Trading Simplified, Charting Your Way to Profits. This is a new program that I have poured my heart into at the beginning of this year, and we're focusing on the exact steps that I have used over the years to achieve consistent swing trading results. Now, this is a 10-module course, and this is the most comprehensive course we have ever released on swing trading. Now, in this course, you're going to learn how to identify market trends and time your entries with precision. You're going to learn from me the essential indicators that you actually need to succeed without all the noise. You're going to find ways to pick the right stocks, ETFs, all based upon liquidity, volatility, and sector performance. The course is going to empower you with a rules-based system for managing risks, so you'll know when to cut losses and when to let the winners run. And you're also going to learn the psychology of swing trading that'll ensure that you stay disciplined even when your emotions are tempted to run high. And here's the best part. As a followthemoney.com member, you're going to gain access to each of these videos in the course as we release them. We've already released the first 3 modules, and we're releasing a new one every single week for the next several weeks. It's like having a personal guide through every phase of swing trading, whether you're a complete beginner or whether you've been trading for years. So if you're ready to take a more structured approach to the markets, head over to followthemoney.com/join, become a member today, and get instant access to our ongoing Swing Trading Simplified course. We can't wait to welcome you aboard and help you level up your trading skills. I'll see you on the other side.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
Welcome back, friends, to one of the longest running personal finance podcasts on the planet. The Follow the Money podcast, found online at followthemoney.com, and then, of course, on all of your favorite podcast outlets. You can find us there on Spotify, iTunes, all of the different ones that you like. But again, followthemoney.com if you want to learn more about us. We have a lot here for you if you're a new or an aspiring trader or investor, or maybe you got a lot of experience. Well, we got a lot of great tools and resources for you here. Okay, well, let's keep moving on. I mentioned I wanted to talk about a few other topics, and I want to drill down a bit more into oil and gold, and then a few other things as well. So a lot of people are still bullish on oil as we head into 2025. I kind of see a different picture. As I mentioned, the price of oil has been coming down rather precipitously since mid-January, quite frankly, since the inauguration. West Texas Intermediate was trading at about $80 a barrel at that time. It's since fallen to about 66. In fact, it's down, as I record this broadcast, it's down nearly 4% today alone, okay? Along with the dollar and yields, they've been falling. All of this bodes well for what? Inflation, right? But at the same time, what I'm saying is I have a little different view. I believe crude prices will probably remain under pressure in 2025, and I think that creates some risks and opportunities, of course. The Trump administration has made it very clear that they want lower energy prices. Why? Because they're trying to get inflation down. So I don't see them really allowing oil prices to rise too much right now. I think they're going to try to get them down. They might come back up a little later, but I think they're going to try to keep a lid on those prices. And we've seen also that OPEC Plus has increased production, so that's keeping a lid on prices. The U.S. is ramping up domestic production even further, adding further supply. Lower energy prices, of course, benefit consumers and sectors that rely upon a couple of key areas, transportation and logistics. And so that's why I'm watching transportation stocks. I think some certain utility stocks are also going to benefit from this. I really like the clean energy space. It's difficult to get bullish about it in the Trump administration, underneath a Trump presidency, because Trump has tended to be somewhat skeptical of clean energy, as much of the country is. I still like the space. I think there's a lot of opportunity there. And we are seeing some really interesting prices on some good companies in that space. I'll be talking more about that soon as well. So those are some of the areas I'm watching when it comes to oil and energy. I'm pretty bearish on crude this year. I don't think it's going to go too much lower, but I think we're going to see that price level out, and it won't be as elevated as it has been in the past, which is really going to help that inflation figure, which is going to, again, make it easier for the Fed to cut rates if it's not dealing with this constant resurgent inflation pressure. Now, even in a bullish market, you always want to have some hedges. And right now, of course, we're still in a big uptrend in the overall market, but it doesn't feel like a bullish market, does it? It feels very bearish. Well, in the near term, it is. I mean, we're certainly in a near-term downtrend, but not in a long-term downtrend. So, but even in a long-term uptrend, you still want to have some hedges. And right now, I think there's some smart ways to protect your portfolio while keeping exposure to the upside. Some people, especially, as you get older, you don't want to be all in the risk bucket, right? We often talk about the safe bucket and then the risk bucket. And, when you're younger, more of your money is going to go into that risk bucket. You don't really care. Time is on your side. You don't care about what's happening tomorrow or next week in the market. Who cares? Because you won't be cashing in that 401k or that IRA or taking required minimum distributions for, 20, 30, 40 years. All depends on your age. Okay. But the closer you get to that time frame where you're taking money out, well, you do need to have some hedges, and you also want to put more money in the safe bucket and less in the risk. And it's all kind of a function of your age and your risk tolerance and all of that. That's why we always encourage you to meet with a trusted financial advisor, because you don't want to do your financial planning on podcasts or on YouTube or anything like that. You want to meet with somebody who knows you. And if you need a financial advisor, we've assembled a great team of advisors who really get it. You can always reach out to us at followthemoney.com/advice. Right there, we have a free form you can fill out. We'll put you in touch with somebody who can help you. So we'd love to hear from you if you need that. We really love connecting people with good financial advice. So if we can do that for you, let us know. But anyway, what about hedges? Well, gold remains a strong hedge against economic uncertainty in 2025. And even though gold is sitting near a record high, just below it, we think there's more upside ahead for gold this year. And the reason is because of that falling dollar. As the dollar goes down, gold tends to go up. They're just kind of a seesaw kind of trade. So I think that gold is going to serve as a strong hedge. I am not a big bond buyer or a bond investor, but with U.S. Treasury yields falling, I think you're going to see some strength in bond prices. And so if you're long bonds here, I think you're going to have a relatively good year by the end of the year, because I think rates will continue to fall. And as they do, again, seesaw, the bond price goes up. Again, you got to be very smart and savvy on what kind of bonds you buy. I like long-term corporate bonds. I like high-quality corporate bonds. But again, I'm not a bond buyer or an investor. I tend to focus on equities and commodities and cryptos and things like that. So, but I think that's going to be an area where people are going to find some non-equity hedge. And then also, I got to say, dividend aristocrats, I think, are also a really great place to be looking. Those who want some stability, those companies that have just been paying an increasing dividend year after year for 25 plus years. These are just companies that aren't going to go away anytime soon. And these are the ones that can kind of pad your portfolio to kind of keep you in the game and not have excessive amounts of risk, So I think that's important. Now let's talk about, for those of you out there who are tactical traders, you're tactical investors, let me just say that the key to success in any market is having a plan. Whether you're a trader or a long-term investor, you just simply need to create a plan. And for traders, again, volatility is your best friend. So you're looking for those high probability setups and strong uptrends. And I think there's a lot of opportunity there. For long-term investors, I focus on high quality companies with strong cash flows, pricing power, a moat, industry leadership. There's obviously very important things, along with some certain key fundamental metrics that I really look at closely. And for crypto investors, I have been long talking about Bitcoin and Ethereum, and we have been accumulating Bitcoin, Ethereum for many, many years, and several other cryptocurrencies as well that our members have known about. And I was noticing that in the proposed strategic crypto reserve that the Trump administration is talking about rolling out, that the cryptocurrencies that they had mentioned that were going to be in that reserve, and we don't know all the details yet. We're going to get it, I guess, this week potentially. But when I looked at the ones that they did mention, I was telling our members the other day, we've already told you about all of these, and we've already bought all of these in our crypto portfolio. So it's really neat to have a chance to front run the United States government before they begin really aggressively buying some of these cryptos that we've been telling you about for years. I mean, literally a decade or more, right? So that is pretty incredible. But we do think that the cryptocurrency is going to have a fantastic year this year, despite the noise, despite the current weakness. If you can look past the current noise, I think that we're going to see a very strong return for many of these high-quality crypto assets as we head into the remainder of the year. Now, at the end of the day, what separates successful investors from everyone else is what? Well, patience and discipline, right? So volatility is not going to deter me from my long-term investing strategy, and I don't think that it should deter you either. So my plan is to continue my weekly dollar cost averaging into my long-term investment portfolio. So every Friday, we alert our platinum members through our private Twitter feed to what I'm buying. I buy every single Friday. I buy more stocks and crypto, and we are transparent and want to share that with our members. And so we share what we're buying. And if you want to know what we're buying each and every week, you can become a platinum member here at Follow the Money and have access to our private Twitter feed. And that's where I share, a lot of that information. So if you're dollar cost averaging as well, you can kind of peek over my shoulder and see what I'm doing. And it kind of gives you some insight as to what others are doing. So I'm going to continue my weekly dollar cost averaging despite what's going on. In fact, when I see volatility, it makes me more excited to dollar cost average into my long-term portfolio. I'm going to continue to add my favorite positions. I'm going to seek out new opportunities. I got a whole list I'm going to be sharing with our members here of high growth stocks that we've been paring down this list now for a while. We've got a nice basket of stocks that we consider these dollar cost average candidates. And, we kind of wait for them to kind of hit a certain price before we would consider buying them. But I'm going to be sharing this list very, very soon with our members. And we're going to be talking about that a lot more. I'm looking forward to finding some new opportunities in this current market. And then I remain, again, bullish on quality stocks, quality ETFs, quality cryptocurrencies, think Bitcoin and Ethereum, over the long term. So what can you do out there as you're listening to this broadcast? You say, well, what can I do in this current environment? My advice is to stay diversified. Volatility is here, but great investments obviously are available to you. They're available to you right now. You want to identify those key winners. I think tech, infrastructure, automation, strong balance sheet companies. I think these are the ones that are going to lead. You want to avoid, as I had mentioned, overexposure to risk. You want to keep, an eye on the fact of how close am I to retirement? Do I want to, put all my money in a risk bucket? I don't think so. I have some safe bucket money and some risk bucket money as well. And then have a game plan for market overreactions. The best trades happen. I found this over the last many years of trading and investing. The best trades happen when other people are panicking. So this is not the time to sit back and wait. Right now is the time to be looking for opportunity. All right, friends, welcome back to the final moments of today's broadcast. I hope this has been helpful for you out there. We do have, obviously, a pretty wild year already that's afoot. And, history has shown that the best returns come to those who stay the course, who invest wisely, and who seize opportunities when the market presents them. And I believe that here in Q1 of 2025, we have one of these moments. Throughout history, markets are typically shaped by cycles of uncertainty and disruption, and today we find ourselves at another one of these moments. We got tariffs, we got trade wars, we got shifting global alliances, we have inflationary pressures that are making headlines, we've got questions about the Fed, what are they going to do? All of this is creating fear and volatility. And as I said, the market does not like uncertainty. And as investors, we must remember that volatility in that time of uncertainty is not really our enemy. It's really the place of opportunity. It's that place where we can really take advantage and seize the day, so to speak. And as always, I like to leave you with a final word, this time by Sun Tzu, who once said, "In the midst of chaos, there is also opportunity." That couldn't be more true for us today, could it? We've got the news cycle that continues to push fear, but those who maintain discipline and seek quality investments and position themselves strategically, I really believe are going to thrive in the long run. So I'm staying the course, sticking to my proven strategies and viewing these disruptions not as obstacles, but as entry points for future gains. And for those who are prepared and patient and willing to take advantage of some of these current prices, I think this could be one of the better wealth building moments for us as we have a long-term time horizon for those portfolios that we're building in our 401ks or our IRAs, whatever you're doing there. Just stay the course. The question is, are you going to be ready to seize the opportunity when it comes? And that's just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and I'll look forward to seeing you right back here next time. Until then, God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.